Welcome to The Millionaires, which help you better understand personal finance, investing, and wealth management. We believe that financial literacy is crucial for everyone, regardless of their background or financial status. In this video, you will know about the psychology of investing, how emotions affect your financial decisions. Investing can be an exciting and rewarding experience, but it can also be a roller coaster ride full of emotions. As humans, we are wired to react emotionally to everything that happens around us, and the world of finance is no exception. In fact, emotions often play a significant role in the financial decisions we make. Understanding the psychology of investing and how emotions affect our financial decisions can help us become better investors and achieve our financial goals. In this video, we'll explore the various emotions that can influence our investment decisions and provide practical tips on how to manage them. Fear. Fear is one of the most common emotions that investors experience. Fear often arises when we perceive a threat to our financial well-being. For example, a stock market crash, a company going bankrupt, or a job loss can trigger fear. Fear can cause investors to panic and make irrational decisions such as selling all their stocks, pulling out of the market altogether, or hoarding cash. The problem with reacting to fear in this way is that it can lead to missed opportunities. Investors who sell their stocks during a market downturn may miss out on the rebound when the market recovers. Pulling out of the market altogether means missing out on potential gains, and hoarding cash can result in missed opportunities for growth. Moreover, research shows that timing the market is very difficult, and most investors who try to time the market end up losing money. So, what can you do to manage fear when it comes to investing? The key is to have a long-term perspective and a well-diversified portfolio. A well-diversified portfolio means investing in a mix of assets such as stocks, bonds, and real estate that are spread across various industries and regions. This helps to reduce the risk of any one investment negatively impacting your overall portfolio. Having a long-term perspective means recognizing that market downturns are a normal part of the investing cycle, and that they are often followed by recoveries. By holding on to your investments during downturns, you may be able to benefit from the eventual rebound. Greed. Greed is another common emotion that can influence our investment decisions. Greed is the desire for more wealth or profit than what is reasonable or necessary. Investors who are driven by greed may make risky investments, or chase high returns without fully considering the risks involved. This can lead to losses when the investment fails to perform as expected. One of the most famous examples of greed in investing is the dot-com bubble of the late 1990s. Many investors were chasing high returns from internet stocks without fully considering the risks involved. When the bubble burst, many of these investors lost a significant portion of their wealth. To manage greed when it comes to investing, it's important to have a clear investment plan and to stick to it. This means setting realistic investment goals and sticking to a diversified portfolio that matches your risk tolerance. It also means avoiding get-rich-quick schemes and investments that promise high returns without any risk. Overconfidence. Overconfidence is another emotion that can affect our investment decisions. Overconfidence is the belief that we are better than average investors and that we can consistently beat the market. This can lead investors to take on excessive risk or to make investments based on hunches or intuition rather than research. The problem with overconfidence is that it can lead to poor investment decisions and losses. Studies show that most investors underperform the market, and that even professional investors often struggle to consistently beat the market. Overconfidence can also lead investors to ignore warning signs or to dismiss negative news about their investments. To manage overconfidence, it's important to stay grounded and to base investment decisions on data and research rather than intuition or hunches. It's also important to recognize that even the most successful investors experience losses and that market fluctuations are normal. Having a long-term perspective and a diversified portfolio can help to mitigate the risks associated with overconfidence. Regret. Regret is an emotion that arises when we feel that we have made a mistake or missed an opportunity. In investing, regret often occurs when we see an investment that we passed up on performing well or when we sell an investment that subsequently increases in value. Regret can cause investors to make impulsive decisions, such as buying an investment that has already had significant gains or selling an investment that has fallen in value. This can lead to losses and missed opportunities. To manage regret when it comes to investing, it's important to focus on your investment goals and to avoid making impulsive decisions based on emotions. It's also important to recognize that every investment involves some degree of risk, and that not every investment will be successful. By focusing on a long-term investment strategy and sticking to a well-diversified portfolio, you can reduce the impact of regret on your investment decisions. Anchoring. Anchoring is an emotion that arises when we rely too heavily on a single piece of information when making decisions. In investing, anchoring often occurs when investors focus too much on a stock's past performance or on a company's reputation rather than considering other factors such as the company's financial health or industry trends. Anchoring can lead investors to make biased decisions that are not based on all of the relevant information. This can lead to missed opportunities and losses. To manage anchoring when it comes to investing, it's important to consider all of the relevant information when making investment decisions. This includes looking at a company's financial health, industry trends, and other factors that may impact its performance. It's also important to avoid relying too heavily on a single piece of information and to maintain a well-diversified portfolio. Herding. Herding is an emotion that arises when we follow the crowd rather than making independent decisions. In investing, herding often occurs when investors buy or sell investments based on what others are doing rather than based on their own research and analysis. Herding can lead investors to make biased decisions that are not based on all of the relevant information. It can also lead to losses when the herd mentality leads to overvalued or undervalued investments. To manage herding when it comes to investing, it's important to maintain an independent perspective and to base investment decisions on research and analysis rather than following the crowd. It's also important to maintain a well-diversified portfolio that matches your risk tolerance. In conclusion, emotions play a significant role in our investment decisions. Fear, greed, overconfidence, regret, anchoring, and herding can all lead to poor investment decisions and losses. To manage these emotions, it's important to have a clear investment plan, a long-term perspective, and a well-diversified portfolio. It's also important to base investment decisions on data and research rather than intuition or hunches, and to maintain an independent perspective rather than following the crowd. By managing our emotions when it comes to investing, we can become better investors and achieve our financial goals. Okay friends, I hope you like this video and you get good knowledge from it. Don't forget to subscribe to the channel for such a valuable video. Thank you for watching.